Economist Paul Samuelson famously said, "When the facts change, I change my mind. What do you do, sir?" And legendary investor Warren Buffett is certainly no stranger to changing his mind. He's of course best known for long-term investments in great companies with strong competitive advantages, companies like Apple, Coca-Cola, American Express, and more. But in a recent video, I covered some of Warren Buffett's ventures into different styles of investing, such as arbitrage. Buffett is open to allocating his cash to all types of intelligent investments, investment opportunities that have a high probability of an adequate return and a low probability of a permanent loss of capital. And an investment category that Buffett over time has occasionally viewed as an intelligent one, and an area where the facts have certainly changed a lot in the past 40 years, is in the area of bond investing. In Buffett's 1988 letter to Berkshire Hathaway shareholders, he explained that his investments generally fall into one of 5 categories. 1. Long-term common stock investments. 2. Medium-term fixed income securities. 3. Long-term fixed income securities. 4. Short-term cash equivalents. And 5. Short-term arbitrage. In this video, I'd like to cover some of Warren Buffett's occasional ventures into the world of fixed income or bond investments. So, if you enjoyed this video and haven't subscribed to the Investing with Tom channel just yet, please be sure to do so. Now, in more recent times, Warren Buffett has been very negative on the prospects of returns from bonds and for the fixed income investor, even going so far as to say that if he had a low-risk way of shorting bonds in substantial size that would move the needle for Berkshire, he would go ahead and do that. And this is what he said in an interview with CNBC back in 2015.
If I had an easy way and a non-risk way of shorting a whole lot of 20 or 30-year bonds, I would do it. But that's not my game, and it can't be done in the kind of quantity that would make sense for us. But I think bonds are very overvalued. I'll put it that way. Now, whether the central bank has the capacity to keep them in that situation almost indefinitely, so. We'll see what happens on that.
Now, at the time of that interview, US 10-year Treasury bills, which are a good kind of benchmark for bond yields in the US, were yielding about 2%. And if you put them in sort of a business or stock kind of context to do some analysis on that as a potential investment, it's kind of like paying 50 times earnings for a stock. If you pay 50 times earnings, you're getting a 2% yield, which is exactly what you were getting on 10-year Treasuries at that time. Now, of course, all things being equal with stocks, the lower the price you can pay, the better the return you're typically going to get. So if you're paying 50 times earnings, which is a very high multiple of kind of current business performance, you would expect that underlying business to grow a lot in order to justify paying a 50 times multiple on their current earnings. But in the case of a 10-year bond, that 2% coupon is fixed for 10 years. So you're paying effectively 50 times earnings for a, quote, sort of business that sure is very low risk. Those payments are very likely to turn up given that it's the US government paying them, but they have absolutely zero prospect for growth, and for that reason Warren Buffett viewed them as very, very overvalued. Now, Buffett through Berkshire never actually ended up shorting bonds as far as I know, but he did do something kind of analogous to that, which was to sell a lot of long-term bonds. And you can see here in Berkshire Hathaway's latest annual report that at the end of 2021, they had over $39 billion in borrowings, a large portion of which was issued in countries that have unbelievably low interest rates. Take some of the Japanese yen-denominated bonds that Berkshire sold. They had a weighted average interest rate of only 0.6%, and some of those bonds aren't due to have their principal repaid until as far out as 2060. But as the facts change, Buffett changes his mind, and at a time now where interest rates are starting to go up fairly materially for the first time in a very long time, I thought it would be interesting to look back at a time where Buffett was on the other side of these types of trades and was actually buying bonds for Berkshire Hathaway and generating, as he tends to do, very, very good long-term returns. Now, more specifically, between 1983 and 1992, Warren Buffett was very active in accumulating accumulating a range of different fixed income investments. Some of these were corporate bonds, some of them were convertible preferred shares, and at the end of 1992, Berkshire's top 7 fixed income investments were worth a market value of about $1.95 billion, which represented about 22% of Berkshire's total net worth. Perhaps the most well-documented bond investment that Buffett made through that time began in 1983 with the purchase of the so-called Projects 1, 2, and 3 of Washington Public Power Supply System, or as Buffett later termed them, WPPSS. Now, the first mention of these particular bonds came in Buffett's 1984 letter to Berkshire shareholders. He said, from October 1983 through June 1984, Berkshire's insurance subsidiaries continuously purchased large quantities of bonds of Projects 1, 2, and 3 of WPPSS. This is the same entity that on July 1st, 1983 defaulted on $2.2 billion of bonds issued to finance partial construction of the now abandoned Projects 4 and 5. While there are material differences in the obliges, promises, and properties underlying the two categories of bonds, the problems of Project 4 and 5 have cast a major cloud over Projects 1, 2, and 3, and might possibly cause serious problems for the latter issues. In addition, there have been a multitude of problems related directly to Projects 1, 2, and 3 that could weaken or destroy an otherwise strong credit position arising from guarantees by Bonneville Power Administration. Despite these important negatives, Charlie and I judged the risks at the time we purchased the bonds and at the prices Berkshire paid, much lower than present prices, to be considerably more than compensated for by the prospects for profit. And Buffett goes on in detail to explain how he and Charlie Munger think about kind of weighing up bond investments against stocks and other investment alternatives that they have. He says, as you know, we buy marketable securities for our insurance companies based upon the criteria we would apply in the purchase of an entire business. This business valuation approach is not widespread among professional money managers and is scorned by many academics. Nevertheless, it has served its followers well, to which the academics say, well, it may be alright in practice, but it'll never work in theory. Simply put, we feel that if we can buy small pieces of businesses with satisfactory underlying economics at a fraction of the per share value of the business, something good is likely to happen to us, particularly if we own a group of such securities. Buffett then went on to say that he basically applies this exact same framework to bond investors. We extend this business valuation approach even to bond purchases such as WPPSS. We compare the $139 million cost of our year-end investment in WPPSS to a similar $139 million investment in an operating business. In the case of WPPSS, the quote business contractually earns $22.7 million after tax via the interest paid on the bonds, and those earnings are available to us currently in cash. We are unable to buy operating businesses with economics close to these. Only a relatively few businesses earn the 16.3% after tax on unleveraged capital that our WPPSS investment does, and those businesses, when available for purchase, sell at large premiums to that capital. In the average negotiated business transaction, unleveraged corporate earnings of $22.7 million after tax, equivalent to about $45 million pre-tax, might command a price of $250 to $300 million or sometimes more. For a business we understand well and strongly like, we will gladly pay that much, but it is double the price we paid to realize the same earnings from WPPSS bonds. So here we really have the complete opposite situation to what Buffett was talking about in that 2015 interview where treasuries were basically yielding nothing. He's instead buying bonds that have north of a 16% after-tax yield, which would be the equivalent of buying a stable business for about a PE of 6 or so. And just like often happens in stock market investments, that opportunity for Buffett and Munger emerged because of largely unjustified fear in the market. Buffett, however, does go on to lay out some important other differences to consider between stock and bond investments. He says, however, in the case of WPPSS, there is what we view to be a very slight risk that the business could be worth nothing within a year or two. There also is the risk that interest payments might be interrupted for a considerable period of time. Furthermore, the most that the quote business could be worth is about the $205 million face value of the bonds that we own. an amount only 48% higher than the price we paid. This ceiling on upside potential is an important minus. It should be realized, however, that the great majority of operating businesses have a limited upside potential also, unless more capital is continually invested in them. That is so because most businesses are unable to significantly improve their average returns on equity even under inflationary conditions, though these were once thought to automatically raise returns. And this treating a bond as a business sort of analytical framework did clearly offer Buffett and Munger quite a significant advantage in analysing these kind of fixed income investments. Buffett explains that by saying, our approach to bond investment, treating it as an unusual sort of quote business with special advantages and disadvantages, may strike you as a bit quirky. However, we believe that many staggering errors by investors could have been avoided if they had viewed bond investment with a businessman's perspective. For example, in 1946, 20-year AAA tax-exempt bonds traded at slightly below a 1% yield. In effect, the buyer of those bonds at that time bought a quote business that earned about 1% on quote book value, and that moreover would never earn a dime more than 1% on book, and paid 100 cents on the dollar for that abominable business. If an investor had been business-minded enough to think in those terms, and that was the precise reality of the bargain struck, he would have laughed at the proposition and walked away. For at the same time, businesses with excellent future prospects could have been bought at or close to book value while earning 10, 12, or 15% after tax on book. Probably no business in America changed hands in 1946 at book value that the business believed lacked the ability to earn more than 1% on book. So, as he often does, Warren Buffett has a phenomenal kind of clarity in explaining how the everyday investor should think about buying bonds, and to me it makes a whole lot of sense to think about bonds exactly the same way as you would think about stocks. You're really just trying to allocate your capital in the best way you possibly can in order to earn a good return without taking, absurd levels of risk. So how exactly did this particular bond investment play out for Warren Buffett? Well, it was about a 10-year long investment in the end, and this is kind of the timeline of how things played out. This is in 1985, about 2 years after the initial purchase. At year end, our insurance subsidiaries had about $400 million in tax-exempt bonds, of which $194 million at amortized cost were issues of WPPSS. Our unrealized gain on these bonds at year end was $62 million, perhaps 1/3 arising from the upward movement of bonds generally, and the remainder from a more positive investor view towards WPPSS 1, 2, and 3s. Annual tax-exempt income from our WPPSS issues is about $30 million. The next year, in 1986, he said, at year end we own WPPSS issues having an amortized cost of $218 million and a market value of $310 million, paying us $31.7 million in annual tax-exempt income. In 1987, we added to our WPPSS position. During 1987, at year end we had holdings with an amortized cost of $240 million and a market value of $316 million, paying us tax-exempt income of $34 million annually. In 1988, he said, we explained the reasons for our WPPSS purchases in the 1983 annual report, and are pleased to tell you that this commitment has worked out about as expected. At the time of purchase, most of our bonds were yielding around 17% after taxes and carried no ratings, which had been suspended. Recently, the bonds were rated AA- by S&P. They now sell at levels only slightly above those enjoyed by top-grade credits. The next year, in 1989, just after mentioning that they had sold off some of their lower-yielding fixed income investments and bonds, he said, we have kept all our high-coupon WPPSS issues. Some have been called for redemption in 1991 and 1992, and we expect the rest to be called in the early to mid-1990s. And finally, let's fast forward to 1992, 9 years after the first investment. This is the final mention of these bonds that I can find in any of Buffett's letters, and this is what he had to say. During 1992, we added to our holdings in ACF debentures, had some of our WPPSS bonds called, and sold our RJR Nabisco position. Over the years, we've done well with fixed income investments, having realized from them both large capital gains and exceptional current income. Chrysler Financial, Texaco, Time Warner, WPPSS, and RJ Nabisco were particularly good investments for us. Meanwhile, our fixed income losses have been negligible. We've had thrills so far, but no spills. So thrills so far, but no spills is a pretty characteristic understatement here for Buffett. He essentially held most of those WPPSS bonds for about 9 or 10 years, and he earned 17% after-tax returns, which for most people investing in the stock market, that would be like a home run, exceptionally good decade. I think most people would take that every day of the week. So to earn that from a fixed income bond investment is a pretty unbelievable result. So I think there's a couple of main lessons here from Buffett that the everyday investor can take away. Firstly, most of the time Warren Buffett does have an overwhelming preference for buying businesses. That's generally where he can get the best returns, but occasionally, other forms of intelligent investment do arise, like in this case, these very kind of mispriced and misunderstood corporate bonds. The second thing is that by taking a business-minded approach to analysing an investment, the investor can get a really good understanding of kind of where they sit and whether they should be buying or potentially even selling bonds. In the case of the WPPSS example, that looked much more attractive to Buffett given its price and yield and so on, compared to what he could buy a private business for. He would have to pay much more for a private business to get the same sort of after-tax income. But in more recent times, as conditions have changed and as interest rates have been lower, Buffett has turned around, kind of done the exact opposite, and he's been a net seller of bonds to raise cheap cash for Berkshire's other investments. So thank you very much for watching the video. If you did enjoy it, please be sure to subscribe to the channel. But that's it from me for this one, and I'll see you in the next video. Cheers.